Welcome to the Global Rewire podcast. My name is Craig Torres, and my co host is Fabio Natalucci, the CEO of the Anderson Institute. Today, our guest is Julia Coronado, a longtime teacher of mine about bond markets, Fed policy, and the economy. And let me tell you about Julia. She's done her fine analytical work at the Federal Reserve, at a couple of Wall Street trading desks, at a hedge fund, and then she struck out on her own to found Macro Policy Perspectives. So, before we get started, I'm going to remind everybody, as usual, that the Anderson Institute has no partisan affiliation. We don't accept money from parties, political influence people, or foreign donors. We just do analytical research here and focus on the facts. So, with that, take it away, Fabio.
I also want to add that Julia is also a really good friend. And so I'm very glad she's here to discuss about the economy and the Fed and more. So thanks for joining us.
It is my pleasure.
Why don't we start with the economy and just start getting your view before we go into policy, monetary policy or fiscal policy, your take on the labor market, right? There was data a few days ago. Where do you see the labor market at this point? Where do you see it going? Maybe start with that.
So the labor market, we got more mean reversion than we were expecting, but we were expecting mean reversion. So what do we know for certain about the labor market? We know that labor supply is minimal. So that reflects both, very, very and ever increasingly restrictive immigration policy, and also the transition into retirement of the baby boomers, which seems to be accelerating. So the combination of those things means that it looks like the labor market has been shrinking this year on balance. That means you don't really need to create any jobs to keep unemployment steady. And even like upper bound estimates aren't above 50,000 per month. So we had gotten a string of close to 200, 150K, an average of above 150K in the 3 months ending in May. That looked implausible. There were seasonal issues. There was pull forward of hiring because of warm weather. And it just looked ripe for mean reversion. And we got that. So you step back and look at kind of the trends, and what we see is massive, massive sectoral disruption. So, education and healthcare, state and local governments getting, taking it on the chin from budget cuts and, cuts to programs. Meanwhile, anything tied to AI, the manufacturing sector is picking up, construction's doing okay because, the rest of construction is doing terrible, but you need people to build data centers. So you've got a mix of cross currents. On balance, it looks like we have a low, stable hiring trend amidst a lot of monthly noise. And the demand data kind of bears that out, right? The GDP is tracking just below 2% in the first half of the year. That's around what we think trend is, particularly, given shrinking labor force and solid productivity, that gives us something close to 2%. The unemployment rate's actually fallen this year, but it's been between 4 and 4.5 for 2 years now. So remarkable resilience, I would say, not a huge danger of an imminent weakening, um, but a lot of disruption under the hood, a lot of stand in the gears, and that's a broader theme in the economy, not just the labor market.
Can I go back for a second to this? So a big driver of the activity has been AI, right? The broader defined AI ecosystem, right? Data center, power, take a broad definition. That piece, that's an interest rate insensitive. So that's a challenge in some sense for monetary policy. But also on the labor side, a lot of that labor demand is very specialized. You probably require fewer workers and more specialized workers. How much of that fit into this year at this point in terms of where the labor market is?
Well, it's an excellent framing because, yes, AI is very capital intensive, first of all, and a lot of that capital is being imported. So you look at the pattern in GDP, this huge Capex boom is not as accretive to US growth as the headline numbers suggest because we're importing the chips. We're importing a lot of the sophisticated components So trade has been a big drag. You're doing double-digit Capex, but you're importing most of it so far. So it's not accretive to US growth. It's capital intensive. It's not that accretive to the labor market. So we're losing very support for very labor intensive sectors like state and local governments and um, education and healthcare, but we are replacing it with less labor intensive uh, uh, demand. And that's hasn't resulted in a net weakening, partly because we've shocked the supply side of the labor market. So you're not adding workers at the same time that you've shocked demand. And the two of them have sort of decelerated in tandem, resulting in a stable unemployment rate.
It may continue as well, right?
Yeah,
This is
yeah.
not just a short-term trend.
Yeah. No, there's this trend is well in place. Some have likened the AI boom to a form of Dutch disease, and this kind of gets to your interest sensitivity point that, there's such a voracious demand for capital to build out this AI capacity that it is, it's pushing up interest rates and or contributing to the rise in longer term interest rates. And that in turn is crowding out growth in real estate sectors outside of data centers or in car demand or other sort of interest sensitive areas of the economy are suffering. There's really not a lot of momentum in the economy outside of the things that are tied to the AI build out. And there are a lot of things. There's a lot of manufacturing and service provision to this sector. So it's enough. But it's hardly the 3% growth that, the sort of the bullish tech optimists were promising. That doesn't look like something we can achieve anytime soon.
Despite all this, there does seem to be a bit of stagnation and underutilization in the labor market. If you look at long term unemployment, that's up in this administration. U6 is up about a point. Um, the decline in participation, some of that has to be discouragement because it's really hard to get a job if you're talking to anybody who's applying right now. It's really, really discouraging. So we were talking among ourselves this morning, and maybe monetary policy isn't the answer, but clearing up uncertainty might be a better answer. What do you think?
Good luck. Good luck with that. I totally agree. Again, we think of that in terms of the sectoral friction. So, let's say that you are, in the health research, sector, and you lose your job or your project loses funding, and you can't just those jobs don't grow on trees. You can't just go out and get another one. It's a sector that's losing steam. So if we see this super pronounced decline in labor force participation amongst men 55 and older, and I think it has many contributors. So yes, it's aging baby boomers, the normal retirement story. Two, you might have some wealth effect on retirement, a booming stock market. Some people might decide to move their plans forward, lock it in. And then those who are losing their jobs are having a harder time. If you are in a sector where AI is disrupting your profession or the work that you're going to have to do in the next few years and you're 60 years old or late, you might just say, you know what, forget it. And then you look at wage growth and the labor share of GDP, and no, it's not a strong labor market. Wages are not keeping up with inflation this year. So you're looking around and you're not seeing good opportunities. The conference board measure, of jobs plentiful minus jobs hard to get doesn't it looks terrible. Looks like consumers don't see the labor market as strong in any way, shape, or form. So I think that decline in labor force participation is a combination of some aging demographics, which are sort of this slow moving structural trend, and then some of the disruption and frictions and discouragement. So it is a complex picture. Some of the measures of underutilization that you cite, we can look at the gap between U6 and U3, the share of part time workers and the labor force, long term unemployment. There's a lot of things that have moved up in the last couple of years. They're kind of in a range. They're not deteriorating rapidly, but they're definitely say that the labor market isn't tightening. So despite an unemployment rate that's ticked down, and there's a lot of I think there's a lot of confusion in markets or there's not confusion. It's harder to read the tea leaves and there's more of a range of views because there's a lot of people looking back to the 90s and saying, oh, when we get this big leap forward in technology that comes with an investment boom, it tends to be accretive to growth. Growth is going to broaden out. And we're seeing a crazy Q3 earnings season, right? Profits are booming. But I don't think that, our view is that it's much more complicated. There's a thousand ways that this is not the 90s. The profit share is high, the labor share is low. There's a lot of tensions there. We see it in the politics of the country. We see it in consumer sentiment.
So maybe the solution is not looser monetary policy. If you look at financial conditions, I don't think they look moderately restrictive. I think they look about right or even a little bit loose. So, what is the policy fix to give this labor market a nudge? So we have. Let me just say it. I don't think we're succeeding on that side of the mandate. I think it looks stagnant, less dynamic. No Fed official should be happy with this. They seem very okay. They give it a C, like it's satisfactory. That's not what the law says. It says maximum employment, and this is not it. So, what is the fix?
I first of all, I agree that the assessment is, that's too simplistic an assessment that we're meeting the mandate there. The reason they come down there is because the other side of the mandate they're failing very clearly. And this inflation, this is also a new dynamic. We're not used to thinking about, repeated supply shocks as the driver of inflation, or we calibrate our whole, the whole reaction function, the structure of the summary of economic projections, Janet Yellen's loss function, all of this is based on demand. And we actually have a lot of frictions on the supply side all over the place. The labor market, wars, the energy demands, the tariffs, the shifting global partners, the shifting immigration. All of this is just massive fistfuls of sand thrown into the gears of the US economy so far again, like we're a hugely diversified ocean liner. It's really, really hard to tip the US economy over. And there are, things that are super strong and things that are just really weak. And on balance, it's okay. But again, not a lot of people outside the AI sector feel great about the economy. So that then what is the solution? I think the Fed does not have the luxury of easing policy right now. It is not these are fiscal policy choices. Every single supply shock we are experiencing is a fiscal policy choice. And you can sing from the hymn sheet that this is all gonna be, lead to a big productivity jump, maybe, but also in the near term, it's causing a lot of strain in certain sectors and really, really disrupting like you see in the higher education sector, is we're experiencing a brain drain. This could have very long-tailed ramifications too, just like AI development could. So, there's lots of shocks that the economy is absorbing, and the net effect on growth potential over the next 5 years, I think is far from clear. And let me just say, I believe that AI is a general purpose technology that will be adopted, that will lead to, a lot of productivity enhancements but at the same time, there's other things going on. It's not just AI. We're disrupting all everything tied to education, research. We're undermining our institutions, our rule of law, our transparency, independence of the central bank. What are the long-term ramifications of that? I think the bond market is starting to get nervous about some of these things.
Julia, can I go back for a second to your statement about the Fed doesn't have the luxury to ease policy? Two questions here. One is everything you just said so far, all these factors driving the labor market, it's not clear to me at all, even if you ease monetary policy, what that would do. Those are structural issues, right? It's not going to be the 50 basis points lower.
50 basis points lower would probably just be more stock market appreciation, which you probably don't
Exactly.
want.
In fact, but also the borrowing cost, they're not tight. They're not high in the sense that corporate spreads are tight, or equity market is high. So it's not obvious to me what an easier policy would do to fix the labor market. The second one is I don't think policy is tight either. Right? If you look like the front end real rates, they're barely above zero. Um, that's not what the market is kind of embedding. Like a few days ago, I was looking at like a 1 year forward real rates, like say 9 to 10 years from here. That rate is 3.25. Uh, it is true that long-term inflation expectation in markets are well anchored, but they seem to be conditioning of that tighter policy to get to 2%. And I'm not sure how you get there with considering where real rates are today.
No, I mean, look, I think actually the Fed does have to tighten policy. I think they have to tighten policy, and maybe not a lot, but I think that they're, if we're thinking about the risk premia that's coming into markets at the longer end, at the longer maturities, that reflects some growing concern about fiscal imbalances, about, the stability and the role of the US and the independence of the Fed and, all kinds of factors that can be contributing to that. And the best thing the Fed can do in this complex mosaic of factors is to shore up their credibility with a few rate hikes. That might also kind of tamp down some of the excessive, what might we call this? Irrational exuberance around AI, and, at least signal that they're not gonna that they understand what's going on here. I think easing policy would backfire because you're just adding concerns that the Fed is, not, that's why the bond market reacted when Chair Warsh said that they might change the PCE metric. They use PCE inflation to calibrate their 2%, target. And he said, "Well, we that might change. We're gonna revisit that in January." The market just threw up. It was, "You've been failing for 5 years and now you're gonna move the goalposts?"
Let's talk about that for a minute. So, our Jim Klaus said underlying inflation is hard to measure empirically. And so, can you talk about this? Seems to be what Warsh is focused on. I want a measure of underlying inflation. Okay, we tried that at the New York Fed, and somehow they discontinued it. I'm not sure why.
The idea that a task force in 4 months is gonna come up with a fabulous new measure of underlying inflation or core inflation, whatever you wanna call it, it's just unrealistic. For those of us deep, deep, deep in the weeds of inflation data, and we are inflation specialists. We focus on the nitty-gritty. And we've kicked the tires on the Billion Prices project, and look, that they did not succeed in measuring core inflation very well because it's really hard, because scraping the internet or relying on, private sector measures doesn't get at the things that people spend their money on. I remember one of the examples that Caballero, right, of the Billion Prices Project. He sort of described, when we scrape the internet, we get to buy a sample because the things that you can find on the internet, the prices are skewed towards things that are on sale, that are being promoted, not the items that have pricing power. He used the example of Uggs. Like, Ugg boots are never advertised. They don't have to advertise. They have such demand for their product. They have absolute pricing power. People are gonna buy their Uggs. And I mean, I don't know if this is still the case. This was several years ago. That may have changed and gone out of fashion, but at the time it really resonated. I had a teenage daughter who needed her Uggs every year. So, but it's a good illustration of how hard it can be. The Adobe has had their internet pricing, scraping, and we mine that for signals, and, there's something there, but to have a truly comprehensive, consistent measure, and by the way, you're gonna want something that you can back test over many years, right? So you can know whether it actually captured ebbs and flows of inflation in the past to determine how well it's doing in the present. Well, that's an inherent difficulty with private sector data. Hasn't been around for long. So I think this is why the market reaction, because in measuring, we have many private sector measures in the labor market, and I think Richmond Fed President Barkin just made this point recently. Labor market, we have an embarrassment of riches. We've got ADP, we've got Indeed, we've got LinkedIn, we've got all kinds of private sector data sources that each have interesting things to tell us about the labor market. So even though we've got declining response rates and added noise in the official data, we can triangulate across other measures pretty well, right? I feel like in real time, we've got an okay sense of how the labor market is doing. As you mentioned, sometimes these signals are conflicting, and the labor market picture, I think, is incredibly complex. But then if we turn to the inflation side, man, that is really hard to measure. Show me one private sector measure that has successfully been a leading indicator or even a concurrent indicator of.
It's not like the Fed stuff has not been looking at private sector data.
Well, thank you. Yes, there's that. I mean, this is an interesting sort of leadership style choice by our new Fed chair to sort of insult everybody in the institution that he's taking over. And I mean, obviously, that I don't think that's how he sees it. But yeah, no, I remember in the pandemic there was a whole new section created, right, to explore and calibrate and evaluate private sector sources. That was when I think they formed that partnership with ADP where they like devoted some of their own, the Fed devoted some of its own, firepower to helping analyze their data and formed a better product, out of that. So yeah, absolutely. The Fed's been hard at work in the data mines, keeping track of all these new metrics. There's inherent challenges. The Fed has been super open-minded about exploring new data sources. So has BEA and BLS, by the way. And they successfully have like onboarded, for example, their onboarding of credit card data during the pandemic for the BEA really helped calibrate consumer spending in real time extremely effectively. They couldn't keep using it though because their budget got cut. Well, there we go, right? So maybe you should fund these agencies that are doing the work and the people that know how to do the work. And you might get some better results.
I mean, another answer I think that spooked investor in that press conference was when Chairman Walsh was asked about the tool to bring inflation down. And he talked about the interest rate, but not only the balance sheet. And I think that was at least read, not sure it was his intention, but at least he was read as less enthusiasm to use interest rate tools to bring inflation down as opposed to something else.
Did he mean asset sales? Is that what he meant? Like shrink the balance sheet?
Say asset sales, he said it was vague right on the balance sheet as I recall. But it did sound like an answer that said, I'm a guy that doesn't want to raise interest rates. I think there was a number of answers in the press conference that sounded like that. Again, whether he intended that or not. And that's certainly how the market took it.
Can I ask you both a question about forecasting? So, when I joined the Institute a year ago, Julia, the supply shocks were very much upfront in our conversations. And we've done podcasts with Matteo Maggiore at Stanford. And this just seemed like the right way to assess the world, that we're in a period of rolling supply shocks, to quote Fabio here. What surprised me is only this year have Fed officials come around to this view. And why has it taken so long? Um, and I think we have research again by Jim saying, well, if that's the case, then you should have a tightening bias. If you're in a world of just constantly being shocked, oil, labor.
Yeah. I mean, why has it taken the Fed so long to come around to this? I mean, I think I would Fabio, I'd be super interested in your answer on that. I guess my first reaction to that question is the Fed is very, very careful in its analysis, and it likes to, really, really dive deep into new, constructs of the economy. It doesn't just wanna chase the latest franking or narrative. And also supply shocks sort of by definition are impossible to forecast, right? You think, okay, we've got the tariffs. We know how to model the tariffs. They're a one-time increase in the price level. So we're going to have a period of some price increases and then that will roll off and then we're going to be back to our underlying picture. Oh, but then there's a war. And then, and then there's the AI dynamic, which, going as fast as we're going creates its own sort of supply shots. And so you're not as a forecaster, as a macro forecaster, generally been in the practice of, okay, this is just the nature of fiscal policy right now. It's a shock generating machine. Uh, but it is, and I actually, in some of these business economist groups like NABE and the Conference of Business Economists that I participate in, a corporate economist made the comment that, if you look at industrial policy, so one, industrial policies become more in vogue. Part of that was a reaction to the pandemic. Um, but it even preceded that with the tariffs under the first Trump administration. And so, but the pendulum in industrial policy is swinging so fast from, you know, renewable energy, electric cars, semiconductor domestic production, all the way over to, fossil fuels and AI and, so all the policies that were aimed at boosting one sector have been ripped back, and a whole lot of new policy initiatives been thrown at a new sector. We're not even allowed to even talk about regulating AI, even at the local level, right? Or you'll be threatened by the administration. So that the speed of that pendulum swing, these are capital intensive endeavors. Building renewable energy capacity takes years and dedicated capital of some significant size. Same with the AI, build out. And so having that pendulum swing so fast from one side to the next, and, why wouldn't we expect we already see a backlash to AI. It's a major issue in the upcoming elections. Data centers are an issue. There's a huge backlash. So you could see that pendulum swing back again. And that's really that's a friction. That's an environment full of friction, supply side friction.
Fabio, what's your answer for this forecast
I
inertia?
think there's two issues. There is one is the genuine challenge that Julia was mentioning about identifying shocks, right? So some of them are obvious, like demand shocks, we're used to those. This rolling series of supplies, some of those are cleaner exogenous shock that are very easy to model. Like, I don't know, a war or tariffs maybe. Then you go, some stuff it's a little less clean to me. Take AI, right? Yeah, there might be productivity boosting over the medium term, but in the short term, it's actually operating more through the demand channel because it seems to pushing up inflationary pressure. So it's not obvious how you're going to model that. Just the modeling part. Some of it it's exogenous, some of it is policy driven. There's uncertainty around those. So it's not obvious how to do it. I don't think this scenario analysis discussion it's new at the Fed. It was already going on when you and I were there working. I think the issue, there's a lot of practical issues, right? So whose scenarios, for example, are those the staff scenarios or are those the committee scenarios? Can you get the committee to agree on a set of scenarios? And if you do get it to do you put the appropriate path of policy around that scenarios? People have different reaction function. Do you assign probability to those? So those have been always very challenging issue to tackle, I think, even if they agree that perhaps in this world of this rolling supply shock scenario is the easier way to communicate the reaction function. But you gotta agree on a bunch of this stuff. And to my memory and knowledge, there's never been an agreement about how to do this. I don't think people disagree necessarily in principle, policymakers. The issue is when you write it down, what do you write down, what probability, how you communicate it. Um, Now, it's not an excuse, right? I still believe that's the best way to do it, but there are challenges.
But is there a political dimension to this which the Fed may be unwilling to take on board, which is now we're in a world of competing hegemons and you have great powers competing for minerals, AI dominance, military might, and let's not forget natural resources from copper to oil to whatever we can bully countries to align, give us. So I don't see any of that analysis occurring at the Fed. Maybe it's indelicate. Central banks don't want to go there. But here's my point. At the end of 4 years, this this is very likely to be the state of the world, as Mark Carney said. Two great powers competing.
There is an institution that is designed originally to do this, which is the IMF. No, because you sit in a unique place, right? You don't have a national interest directly to deal with. You sit one layer above. You can take a global view. That's the best place, I think, where the analysis could be done. If you are courageous and adventurous enough to push back against national interest.
I think there's been, at least former IMF people, right? Geeta Gopinath has been writing about the state of the world and people of that mindset, and like yourself from a financial stability perspective, right? Like there's some, I think, good people who have been through the IMF and who maybe now sit in a seat that's more independent, have the luxury. Of course, the IMF, as you know, has to deal with those political delicacies. I mean, that's always been a challenge with China and the quality of Chinese statistics and taking them at face value while, knowing that they're not exactly high quality or representative of what's going on. And, all of that, complication of being an official institution. I think this is a world where, more independent voices are going to be where you get the insights.
So let's talk about that, independent voices. Am I wrong in thinking, wow, Fed presidents have gotten really explicit and transparent and much better at communicating in the last 50 days? Is there something going on? Am I right about this or is it just me?
You are right about this. I think that this was sort of by design. If I might give Jay Powell a little bit of kudos here, I think he had a sort of agenda over the last few years of ensuring that we had a lot more financial market expertise um, on the FOMC. So elevating Lori Logan from a senior staff person to an FOMC participant, Alberto Musalem, Beth Hammock. These are people that have taken risk. They have managed balance sheets. They have managed portfolio operations. They understand financial markets and will be invaluable if and when we have another financial market incident or crisis or emergency. So,
I like incident, the diplomacy of the word incident.
well, financial market people, they're not always, the nicey nice central bankers the way other people are. I mean, which is the way markets function, right? Markets, which is why I always loved having moved from the central bank world to the financial market world, because people really do say what they think, and that's nice. You know what people think, and And the markets don't lie to you. And so I think that style we're seeing amongst some of them reflects that background. And it's coming at a time when, when Kevin Warsh was a governor, he was one of the financial market experts on the FOMC. That's not the case anymore. I mean, he obviously he has been in markets. He's a markets person, but he's got a lot of people on that committee that know as well or better than him how markets function and what the messages they're sending, the signals they're sending. So I think that's why there's more pushback. You can't spin it to me that this was about forward guidance when I know that the market is telling me that it's worried about Fed credibility.
I think you make a good point. I just want to point out that these people were this way under Jay Powell as well. It was Beth who called Jay's last statement with easing bias, quote, misleading. I've never seen a Fed president say something like that, but good for her because it
Yeah,
was misleading. It
it
was
was
misleading.
misleading. It was. She was right, and it was a little bit a part of a it seems like the whole transition featured a certain dose of political economy, both in the statements and the dissents. Very strange for the July meeting to have more dissents because the data actually went the other direction between June and July. It should have been fewer, not more, but it was sort of, well, people didn't wanna be impolite maybe at the first meeting, and, I don't know. So we've had some funkiness in the transition, but yeah, Beth Hammock is having worked with her, on the, Treasury Market Practices Group, I can say, like, Beth is gonna call them as she sees them 100% of the time. So that doesn't mean she's rude. She's very, she's a sharp, intelligent person who's just describing what she's seeing. And she'll hear the other side, but she's not gonna sugarcoat what she's seeing.
Can I ask you, Julia, your view on this now that we are about communication here? This debate of forward guidance versus I don't like framework guidance that President Lagarde used because I don't think you should guide on the framework. The framework should be clear. So I don't like that wording, but communicating about the reaction function, the framework vis-a-vis forward guidance, how much is needed now, how much is not needed now, what should be communicated?
So there's so much gray area. Like forward guidance has become as ill-defined as asset bubble, right? Like what is it that people object to? I think the Fed had some clear mistakes in forward guidance. I think the way they operationalized, the forward guidance in the pandemic turned out to be overly aggressive and not flexible enough. And I think a lot of people agree on that, and the idea of providing promises that aren't data dependent is a no-no in central banking, and honestly, the Fed hasn't done a lot of that. Mostly what they do is data dependent, and they're very careful to say, "This forecast is not a promise. This is a framework for understanding how we will act if the
Okay,
economy."
but just that has never worked. Let's be honest.
It has, it does.
People have not read that as they have assigned much more. I don't want to use the word commitment, but
No, it does, they
much
don't read
more.
it as commitment. The Fed
No, no,
funds.
commitment is not the right word, but it's a little bit more than just we're giving you a sense of where we're leaning depending
I
on the
don't know.
data.
I don't know that I would agree with you. I watch that Fed funds pricing ebb and flow with every wiggle of the data just the way you would want it to do. I don't think the Fed has been, and, they're in a world of greater frictions and greater uncertainty. I think Fed officials have been very clear that I have even greater uncertainty about the outlook, and they are talking more about scenarios. And so we should all take that with a grain of salt. And you do see more ebbs and flows in pricing of Fed policy, over the next year or two. So I don't know that I think that there's a big problem that needed to be solved. Um, you know, I think that there are some sensible tweaks you can make to the summary of economic projections. I think a rolling forecast horizon always has made sense. Shortening it to like 2 years also makes sense to me. We did on in our shadow survey of markets participants, we asked people what they think the Fed should do to the SEP, and we got a lot of, good responses of what people sort of think would be clarify what the SEP is telling us. But I think
I,
there's this.
I think I disagree with you here. Sorry, if I may for a second.
Yeah,
I think there is an overly fixation with that hypothetical median guy that doesn't exist. If you want to have the SCP, in my view, either you are courageous enough to put your name on your forecast, maybe they're never going to get there. You can put colors, numbers. I want to see what your rate forecast is predicated on what GDP and what
I do.
inflation.
I like connecting the dots. I like connecting the dots to the economic forecast and connecting it over time. Because
Because otherwise, you get this guy, you pick the inflation projection, the GDP, it's another guy, the rate is another guy.
totally agreed, totally agreed. That would be a sensible tweak. So I don't think it should be set in stone, and there are ways to enhance Fed communication. I agree with that for sure. And again, we are in an environment where you have to be very clear that there's a lot more uncertainty. The economy is operating in a different way than we've traditionally understood. So we have to that means these relationships are more up in the air and subject to more uncertainty, and therefore so is policy. I think that's important to communicate that. But to go to the extreme of, you notice that going into the July meeting, one consultant wrote a report that said maybe they would surprise with a hike, and then the market got all twisted up and obsessed with the possibility. Will they do a surprise hike? Will they not? And it, that's this kind of thing that can simply be tamped down with some Fed signaling ahead of the meeting, like, relax. And I don't know that it matters either way if you have a lot of anxiety in the week ahead of the meeting or not. Does it matter? Does it make a big difference? Maybe not. But I don't know, but the extreme version of, I shouldn't even tell you what I think about the economy or where I think policy currently is. Is it accommodative? Is it restrictive? How do I view the labor market? How do I view the inflation dynamics? I think every Fed official has the responsibility to communicate that. And um, again, I think it was in Barkin's, NABE, podcast that he, kinda mentioned that, also in communicating that they get feedback from, their staff, from officials, from Fed watchers, from the market, from their constituents, the businesses in their district, and so on. Like, does that make sense to people? How are they experiencing the economy? What are the views out there? So I think it's a healthy dialogue.
I mean, it's as simple as that, right? That 10-year, it's just to simplify, it's the sum of the expected part of policy pure plus risk premium. The expected part of policy, you are the player that sets the expected part of policy. So you're not exogenous.
You are not exogenous. And this idea, like, that there's some pure look, markets have always been a public private partnership. Money is public, money is a public good, right? And the Fed is in charge of the money and the purchasing power of the money. And that's a public good. Sorry, you're never going to get like the pure market discovery. That's not a thing and never has been. Same with the balance sheet. This idea that, oh, if we shrink the balance sheet, that will, take the Fed, let markets operate in a purer state. No, because then you're going to have these added facilities to provide liquidity at quarter end or year end. And that's more intervention. So
What's your forecast on what the balance sheet task force will come back with? It's a good combination of people with different views on the balance sheet, right?
that's probably the most interesting combination because these people have very different ideas, right? So honestly will probably come back to something like the framework laid out by Lori Logan and Stephen Myron, which is the way to address the balance sheet is through demand for reserves. And you can explore different policies that will affect demand for reserves, from regulatory to market functioning to changes in the nature of the facilities, tweaks to the structure of the facilities. So, and if that's a road they want to go down, sure, go for it.
That is not going to shrink as much as I think some expect.
I don't think it's going to shrink it. We're in a world of abundant reserves. That's it. Like ample, abundant, wherever you land.
You can shorten material duration though if you change the composition of the balance sheet.
Potentially, you could shorten the duration of the balance sheet, yes, and you can reinvest in bills, the rollover, that's certainly a policy that if you wanna, but again, that is monetary policy. Like, you're making that's a policy decision to shorten the duration. So, that's a tool in the toolkit for sure, so go ahead, you wanna
No, I mean, my point is like people have been overly fixated on the size of the balance sheet as a share of GDP, but the composition is as important.
the debt absolutely. At least as important.